So right now, there's a lot of focus on how much will the Fed let its portfolio of bonds shrink, and there's expectations that either at tomorrow's press conference or a subsequent one, they'll put a date sometime at the end of this year, maybe a little bit, maybe a $250 million less than they have now on the overall balance sheet. But there's an unresolved question about, is the Fed going to be holding a set of bonds that are equal to the maturity of the Treasury's issuance, or are they going to move more to the short end? And I think that'll have implications both for what difference it makes to yields. Obviously, if they hold fewer long-term bonds, that should put a little upward pressure on yields, but also how prepared they are for the future. The argument for being short is that then in the future, if you have to use something like quantitative easing, your first move can just be to go buy long-term bonds and sell your short-term bonds, as they did during the crisis.
That's the old Operation Twist, right? Sort of?
Exactly.
All right, they're back into the pretzel, Steve, to try to get us out of this odd situation where interest rates are pretty low, yet wages are strong, the unemployment. Is it just going to be a lag before all of this feeds through to the overall inflation number, or is there a global reason why that's not going higher?
The key to Fed policy now is how to prepare for the next recession without creating it. It's that simple, okay? They want to get rates up a little bit in order to have some ammunition without tearing down the economy or stopping the expansion. They want to do what David's talking about, which is to, I think, put the balance sheet in a position where it's as small as it can be and as short duration as it can be in order to allow for the things that David talked about. One thing I do want to say to Rick is, Rick, our survey respondents agree with you, and this is an emerging line of thinking, which is how much the tariffs have been responsible for weakening the global economy. 45% say that is really one of the things that's out there. So it's a big circle here in the sense that you have the tariffs have hurt the global economy. The global economy have in turn been dragging down U.S. growth. And I think that's why, by the way, when the economists first estimated the impact of the tariffs, they had a real minimal impact. And now I think that impact is seen growing beyond what they originally estimated.
Yeah, Rick, I wonder if that means tariffs lead to rate cuts. It'd be interesting.
You know, I understand, and I do agree tariffs are important. As a matter of fact, they were so important that long before income tax was around, it paid many of the bills of the country. But I don't think tariffs per se are the issue or the sticking point why growth isn't accelerating. I think it's more psychological. I think that many managers, why is capital spending so low at the same time? I think it's all part of the same picture. I think that when we get more forward visibility, all these things will fall into place. And I really do love the notion that tariffs is the conversation now, because if we are close and tariffs would be middle in the discussion. So in my opinion, just looking at the fact we've taken out all these tops in the S&Ps, the top in October, November, and December, it's very difficult for me not to think we're going to build momentum and there's not going to be a raft of people and investors that think they missed the last train out of bull market that are going to be jumping on.
David will give you the last word.
I think the tariffs aren't the only issue. Europe is not doing well, and China seems to be slowing down. Tariffs may be part of the China story. That's not the Europe story. And a lot of what's going on with yields here, the stock market, and the dollar is that we're still doing better than the rest of the world.